Okay, so for the question, all right, what we did there was, please let me share my screen as well. So what we did in the question was to solve, uh, to talk about how we are going to treat this investment. The question says, discuss how the investment in Adoa should be treated. All right. And investment in Adoa is an investment in associate. Why? Because we have significant influence in the company. And what gives us that significant influence? Number one, we have three members as part of the board of directors. We have three members. We constitute three board members, right? And also, we are part of their strategic plan, all right? Their strategic plan for their expansion in operation, right? So we are part of it. They need us for that. So that gives us uh, a significant influence in the company. All right. So that is that. And that's why we are treating it as investment in associate. And how do we compute our investment in associate? All right. And our investment in associate. So the first one is the cost of the investment itself. How much did we buy it? Then we had our own our share of profit and loss. If it is a profit, we had it. If it is a loss, we less it. All right. We also had our other comprehensive income, and also we less our share of impairment. All right. We less our share of impairment, and that's what we have there. So that's how to recognize the transaction. All right. So that is that. Now let's look for another question. Like I said, let me send this to the group. These are questions on investment in associate and joint venture. So I'll send the questions to the group now. So now let's go into May 2019 question 5. I've sent it to, has it delivered? Yes, right? We've seen it on the group, right? So May
Please, I can't
2019.
hear you, sir.
Hey, do we have anyone else who cannot hear me? Anyone else who cannot hear me, please?
I can hear you.
Okay, probably you should check your network. All right. So if anyone else can hear
Lord,
you, it
I
could be
can't hear
from your
you. I can't
network.
hear you clearly.
And we are saying the same thing now. Do we have anyone else who cannot hear me clearly? Do we have anyone else who cannot hear me clearly?
No.
Okay. So that means it could be from your network. I hope you can hear me better now. And I don't know that person now. I don't know who that person is. And I hope you guys can see my screen.
Yes,
You can
I
see my
can
screen,
hear
right?
you better now.
Okay, thank you. Now, May 2019, question what? Question 5. May 2019, question 5. Has anyone opened it? Do you need me to share it to the group? Do you need me to share it to the group?
Yes, please.
Okay. You don't have this combined. Oh, I used to have it. Oh, this combined Pathfinder for each diet. I used to have it really. I've sent it to the group.
Thank you, sir.
You're welcome, ma. Yes. Question 5. Sorry, I said it, please. If there is anyone waiting for admission, kindly let me know because I'm opening the material and I may not be on uh the Meet page, the Google Meet page. So someone should tell us, read May 2019 question 5 to us. So that's the requirement, right? So what I usually do is that any question I have that I have to solve at all, I need to look at the requirements, okay? So that we don't end up reading the whole question and it's not what we need. And the requirement is different from what we need. So please, someone should read question 5, May 2019, right? Yes. Someone should please read for us.
Yeah, can I go ahead?
Yes, please go ahead.
Okay. LPG. Okay, let me start from the requirements. Required. Discuss with reference to International Financial Reporting Standards (IFRS) how LPG PLC should account for the agreements in A and A above and the transactions in B for its year ended 31st August 2018. Yes. Can I go on to read the question?
Go ahead, please. Go
Okay,
ahead, please.
thank you. LPG PLC is a publicly traded entity on the Nigerian Stock Exchange involved in the production of and trading in natural gas in Nigeria. LPG PLC jointly owns a gas storage facility with another entity, Tan Oil Nigeria Limited. Both parties extract gas from onshore gas fields in the Niger Delta, which they own and operate independently from each other. LPG owns 55% of the gas storage facility, and Tan Oil Nigeria owns 45%. Savings and costs are shared between them according to their percentage holding. However, decisions regarding the storage facility require unanimous agreement of the parties. The gas storage facility is pressurized so that the gas is pushed out when extracted. When the gas pressure is reduced to a certain level, the remaining gas is irrecoverable and remains in the gas storage facility until it is decommissioned. The Nigerian law requires the decommissioning of the storage facility at the end of its useful life. LPG PLC wishes to know how to treat the agreement with Tan Oil Nigeria Limited, including any obligation or possible obligation arising on the gas storage facility. Ignore accounting for irrecoverable gas. Requirement B. LPG purchased a major gas plant on January 1st, 2018, and the directors estimated that a major overhaul is required every 2 years. The cost of the overhaul are approximately 25 million, which comprises 15 million for parts and equipment and 10 million for labor. The directors proposed to accrue the cost of the overhaul over the 2 years of operations up to that date and create a provision for the expenditure required. Discuss, with reference to the International Financial Reporting Standard (IFRS), how LPG should account for the agreement in A above and the transaction in B for its year ended 31st August 2018.
Yes, anyone? Discuss with reference to IFRS how LPG should account for the agreement in A and the transactions in B for its accounting year. Now, this question, the first thing is that you need to understand, is it a joint operation or a joint venture? Eh?
Joint operation.
Okay, so why do you call it a joint operation? What are the attributes of a joint operation?
Um, I think from the passage there are some information that we're giving, like both parties extract gas from onshore gas field in the Niger Delta, which they own and operate independently from each other. So, which means they are not in joint venture, but they are in joint operation. LPG owns 55% of gas storage facility. So the storage facilities too is co-owned as well, which also form part of their operation.
Is that all, sir?
Uh, let me see. Let me see. Yeah, that's right. I think that's what I can pick for now.
Anyone else? Joint operation or joint venture? And why?
Ah, I don't really know why, sir, but what of the place where it says that services and costs are shared between them according to their percentage holdings? I joined late, but I thought you said joint operations they share equally 50-50.
Me, I didn't say that specifically. Oh. Okay, this is it. All of them, whether joint operation or joint venture, right? It is not necessarily, like I said, it doesn't have to be 50-50 per se. All right? For instance, we can be three
Okay.
now. It can be 60-40, but at least we share it in accordance to our holdings, right?
Percentage holding, okay.
Now, one of the things we did on joint venture is that for joint venture, we are sharing net assets and we are using equity method. Net assets,
Uh,
right?
okay.
But for joint operation, we are sharing income, expense, assets, and liability. We have equal rights to the assets and equal obligations to the liability. All
Okay.
right. Then
Yeah.
also, let me leave this page and go to the question. Also, mm, so he has mentioned one of the things, right? Yes,
Mm,
they own 55 and 45%. And services, you can see, services and costs are shared between them according to their percentage holding. Do you understand?
yes, sir.
And don't forget, regardless of the two of them, before anybody can make any decision, it has to be unanimously agreed upon by all the parties.
Mm,
Right? So
yes.
decisions regarding the storage facility require unanimous agreement of the parties. Hmm? Mhm.
Okay.
Then also, let's look at it one after the other again. I saw some of them before. Now, the Nigerian law requires the decompositioning of the storage facility at the end of the useful life, right? LPG wishes to know how to treat the agreement. You see that decompositioning, you know it's a cost.
Yes, it's a cost.
What is the decompositioning? Is any of you offering advanced tax?
Decommissioning, right?
Decommissioning, yes, decommissioning.
Okay. Yes, a cost.
Sorry. Yeah, so what is decommissioning?
It's like for this particular scenario now,
Mm,
the storage tank has a useful life, let's say 20 years. So
okay.
the cost of um, dismantling the storage tank, I think that's what is referred to as the commissioning cost now.
Yes, you are right. So the cost you incur, for instance, now is like when you use a facility, you lease a facility for like 10 years. Now that facility you have leased, you decided that you want to use it for something else. Then because you want to use it for something else, you have to build your own structure the way you want it to be on it. When you are done with your structure, when you are done with your lease term, and you want to leave that particular facility for the owner, for the landlord, there are costs you incur sometimes. For instance, now you need to demolish the place, your building, and bring the whole building back. You know, there are some landlords that will tell you that if you see any paint in my house, leave it like that. If you know that you want to change your own paint, I'm not saying you should not change your own paint, but when you are leaving my apartment, paint it back the initial paint, the original paint I painted it before you came in. Have you met any landlord like that before? Have you heard something like that before? Have you heard something like that before? Eh? We don't have
Yes,
anybody here
yes.
who has house
Yes, for those of
agents.
us that follow law online,
Which one is law online?
I think there are some lawyers that post some a lot of scenarios online. So
Oh, okay. What platform is that? Because I am a lawyer. I
there,
am a
there are so
prosecutor.
many platforms. I'm
Okay.
sure I'm sure you know lawyer Agbaji.
And yes, I know lawyer Agbaji, but I've never seen any of his
He's
skits
always
before.
posting video.
Okay. So that's it. So in a situation like that, if the landlord says that this is what I want and you have it in your contract, yes, that is the way you want, that is the way he wants it. And some of them will tell you that anything you are bringing in, I don't want to hear any nail on my wall. They'll give you all these things. Now, when you are leaving that apartment and you want to bring it back to the position where the landlord would accept it from you, the cost you are incurring is called a decommissioning cost. Do you understand? That is a decommissioning cost. And for those who are offering advanced tax, you will see it in hydrocarbon tax. So decommissioning cost is there. Now, this decommissioning cost is also to be shared by the two of them. Do we understand now? So that is it. Now, the Nigerian law requires the decommissioning of the storage facility at the end of its useful life. LPG wishes to know how the treatment will be done, including any obligation. Yes, the obligation as well is to be shared by both of them according to their shareholdings. Do we understand, please? Do we understand?
Yes.
Uh-huh. So if how is LPG supposed to discuss it? I think whether someone raised his hand up or someone wants to come in. Okay, nothing is showing here. Okay, now how will LPG record this transaction? Number one, just like we said earlier, LPG is to record its own share of the asset. We said it. And in this case, what is LPG's percentage? LPG owns for 55%, right?
Hello, sir.
Yes, please.
Okay, please, have we concluded? Is it a joint venture or joint operation?
It's a joint operation, sir.
Oh, all right, okay.
It's a joint operation. So for joint venture, you are only treating the net asset, okay? But for joint operation, you take your, you record, let's say, what's the value of that business? They did not tell us the value of the business. So let's say the value of the business is 100 billion naira. That means LPG owns 55 billion of the assets. Whatever asset they have, LPG will record 55% of it as its own in its financial statement. It will recognize it, the 55% of the asset, the total asset of the company. Don't forget, they mentioned something about the asset. Where? They jointly own a gas storage facility, right? Uh, where did they mention the assets, please? So they have a major gas plant, right? So now, going before we go to B, let's recognize them first, right? How do we treat them? Number one, LPG will record 55% of the asset as its own. Do we understand? Then aside that, the assets that they have, they said they purchased another asset, gas plant, right? That's one. The cost of the PPE, the assets they have purchased. And how do we get the cost of asset? How do we get the cost of an asset, please? What makes up the cost of an asset? Yes, what makes up the cost of an asset?
The initial purchase price and other costs that are directly traceable to,
Attributable, okay?
yes.
Like what?
The cost of
That's not
bringing the
all.
asset
Oh.
to the location.
That's number one, purchase price.
Yes.
Mona no
Less
scatter my brain. Let's take it one step at a time. Let's arrange it. We have the purchase price. One.
less trading
Let's what?
less trading discount. Trade
Let's
discount.
We,
rebate.
let's trade discounts. Now,
Yep.
what about cash discounts? What if we have a cash discount?
They are not lessening it.
Why?
Card discount deal with front payment now.
Prompt payment. Rest. Thank you.
Yeah.
So cash discount is not included. Thank you very much for that. You gave me the exact thing I want to hear. Yes, let's trade discounts.
Non-refundable
What do you do to
tax.
non-refundable? Are you adding it or subtracting it?
We add it.
Uh-huh.
We add on
What is an
all
example of a non-refundable tax?
our exile duty,
Custom.
our
Custom
um
duties, excise duties, import duties.
yeah,
What about uh recoverable tax? What's a recoverable tax?
um
VAT.
VAT. Which other one?
yes.
Which other one? Is withholding tax recoverable?
Yes.
Speak
Yes, sir.
loud though. Don't be shy. Oh. Is it recoverable or not? If it is recoverable, how? If it is not, why? Okay, so this is it. You see your withholding tax is one of the lump sum recoverable tax you have. If I collect withholding tax from your account, don't forget, it is the customer that will collect withholding tax on behalf of the government, right? Am I right? Okay,
Yes,
let me
sir.
bring it this way. Who bears the burden of withholding tax? What's the tax burden? Withholding tax burden. Who bears the withholding tax burden?
The vendor or the
The vendor,
subcontractor.
which is the
Yes.
supplier.
Yes.
Thank you very much. Then who is the tax incident? Tax incident is the person who will pay that tax to the government,
The
Abby.
the customer, yes.
So the customer. So which means as a customer, I am to deduct withholding tax, right?
Yes, sir.
Now, if as a customer I deduct your withholding tax, I deduct money I'm supposed to pay you, I paid you 90%. Okay, now, no, let's use contract of supplies now, which is 2%. I deducted 2% of your revenue. That 2%, I'll be the one to pay the withholding tax, right?
Yes, sir.
If I pay that withholding tax, do you know that It only reflects that I paid withholding tax. I'll not be the one to get the tax credit. You know what a tax credit means?
Mm,
You know what tax credit means?
yes.
Only one person is responding. Oh, it seems we want to end this class. Only one
Yes,
person is
so
responding.
yes,
Oh.
so
So the tax credit is that I'll get back my money at the end of the year. So if me as a customer, if I pay withholding tax, I will not see the tax credit. It is you, the supplier, that will see it in your account. And you now get a notification on your tax pro max that someone paid withholding tax on your behalf. So company paid withholding tax on your behalf. So it is a recoverable tax. That's why we call it an advance tax. Although sometimes it is a final tax, right? Like withholding tax on dividend is a final tax. Am I right? Those of you who have done taxation, please let me know. Maybe I'm
Mm.
right or wrong, so that I will know whether I should sue Ican or I should collect my money from this. Okay, I didn't attend any tutorial center. I would have said I should sue the tutorial center where I had my Ican lectures, but unfortunately, I didn't register for any. I didn't register with any tutorial center. I would have said I should just go back there and ask for a refund, or I should just tell CITN to withdraw my license and not give me my my membership license. So that is it, all right? So withholding tax is also a recoverable tax. Value added tax is also a recoverable tax, right? So yes, we add our non-recoverable tax. Yes, what about the recoverable tax? We less that, right? We less the recoverable taxes, right?
Yes, sir.
Yes, what else do we have as the cost of the asset?
Installation cost.
The commission,
Installation costs.
the commission
Sorry. Before we install,
dismantling.
we know, are we not going to carry it before we install it?
And someone said transportation.
Okay, I didn't hear that. So transportation, installation, you are adding them. Then what else? Cost of clearing the
Clearing the
land,
site. Mm.
the site, right? And
Yes, sir.
cost of the initial
Mm.
testing, the cost on the initial testing, and also every other cost incurred in order to make the asset, in order to bring the asset to its working condition, to the condition where it can perform its duty. All these costs are costs of the assets, right? So the PPE also, we recognize the PPE under IAS 16, the PPE under IAS 16, right? So that would be the all the costs we have, including the dismantling cost. Yes, dismantling cost and the cost of removing the item from the site. All right. Eventually, when we want to dismantle it, that cost is also a the cost of the asset PPE. All right. Yes. What else do we have? Now, also, you know that when we are to decommission this asset, right? When we want to decommission the asset, we don't even know the cost of decommissioning the asset yet. Am I right? Am I right? Because the decommissioning will come at the end of the useful life of the asset, which means it is futuristic. And when it is futuristic, already, since there is a law that backs it up that we must decompose, it means that we have a liability at the end of our program, at the end of our joint venture, our joint operation, right? Now that liability, we don't know the cost, or can we recognize the cost? Can we ascertain the cost at this time? No, we may not be able to ascertain the cost immediately. So since we can't ascertain it, then we have to make a provision for that asset. I mean, for that liability, the cost. It's a liability. It's a future cost, right? And it's not just a cost; it's a liability because it is a must. Do you understand? So, yes, the contingent liability is there. Provision, we make provision for the decompositioning. We can call in an estate valuer to give us the value, to measure it for us. And we can use our estimate. Don't forget, right? We can use estimates, accounting estimates for it. And don't forget, for your accounting estimates are to be treated prospectively. White accounting, what's this other one now?
Retrospectively.
Which one is the retrospective treatment? IS 8 is what?
Accounting
Accounting.
estimates and
No, accounting estimate is the last. Accounting what? Before errors. Accounting policies. Sorry, I hear accounting policy. So your accounting policies are to be treated retrospectively, all right? Your errors as well. If it affects your accounting policy, you treat them retrospectively, but your accounting estimates are treated prospectively. All right. So that is that. Are we there? Are we there?
Yes, sir.
Yes,
Then
sir, we
Yes,
are
sir.
there,
also,
but I don't
so
know. I don't know if you could help us write down these answers you are giving us
hey,
because our
nobody's
head
jotting
can
over
forget
there.
some of them.
Ah, you don't have your book, your paper and pen with you. Oh God of the world. Do you
I
have
do,
your
sir. I do, sir.
so please start jotting. And that's why I don't think I'm rushing it this time around. Am I still rushing it? So please start jotting down. I don't have a paper and pen with me, except you want me to be sharing another Microsoft Word or Microsoft Excel to be writing it. So please just start keeping notes of them right now, okay? And I'll mention them again. Number one, LPG is to record the asset, to record its own share of the asset, which is 55% of the PPE, right? Then also, we know the cost of the PPE now, and that cost of the PPE will include the cost of the commissioning, the assets as well. Okay. Then also we have, since we have a decommissioning cost, it is a future cost. That means there should be a provision for that future cost, right? So for the future cost, we have a provision for the compositioning, and we need to measure it. We can have our accounting estimate for that. We measure it. All right. Then also, if we have, okay, then also I can see it here. So LPG wishes to know how to treat the agreement with San Oil Limited, including any obligation or possible obligation on the gas storage. So if there's any possible obligation, obligation is a liability, right? Am I right?
Yes.
So obligation
Yes.
is a liability. So if there is any obligation as well, right, we need to treat the obligation, and that is a contingent liability if there will be any at all in the future. Okay. So any obligation that will be arising in the future, we need to have a contingent liability as well. And if there is any asset in the future, we need to have a contingent asset for that. And when you're having a contingent asset or a contingent liability or provision, you have to measure them in their present value, right? Nobody is responding.
Yes, sir.
Am I right? You measure
Yes,
your
sir.
liability, your future costs, your provision and contingent liability, you measure them in present value. All right. Then also, if there's any other cost incurred, all right, for instance, when it is time for us to dismantle and decommission, that one also we have to share the cost according to our percentage, which is me, LPG. I'm taking 25%, I mean 55% of the cost of dismantling, right? So that is what we have here. Do we have any question from anyone? Do we have any question? No question, right?
Yes, sir.
Okay. So that is that. Now, B question says that LPG purchased a major gas plant in 2018, right? And the directors estimated that a major overhaul is required every 2 years. The cost of the overhaul are approximately 25 million and comprised of 15 million for parts and equipment, for parts and equipment, and 10 million for labor. Okay, for the parts and equipment of that asset, we have 15 million and labor is 10 million. The director proposed to accrue the cost for the overhaul. So what is overhauling in the first place?
Like reshape,
Overhauling.
like repairing, or let me say restoration.
Okay. And how do we treat it? Is it expensed or is it an asset? Is it capitalized or expensed?
Restoration.
You are repeating it, but means I won't repeat them. Yes. Is it capitalized or expensed? And what is overhauling itself? If you are capitalizing it, why? If you are expensing it, why?
Jesus.
I don't know why you're calling Jesus. So you know they are betraying Jesus next week, bah? Sure you know.
Yeah, I
Yes,
know.
sir.
Yes, ma. Go ahead, please.
Yes, sir. I think overhauling needs to be capitalized
Okay.
because we are taking it back to its original condition. So I think it should be capitalized, overhauling, capitalized.
Okay, overhauling should be capitalized, right?
Yes, sir.
Someone thinks. Okay, now. Yes, any other person? So overhauling
So
has to do
overhauling
with.
has to do with.
Okay, go ahead, please.
Okay, go ahead, please. I think overhauling is does not restore it to its original position. Okay, even if it does, actually, it doesn't add any extra values like maintenance.
Okay.
So I think it's needing to be capitalized because it's maintenance. So
So that means
you
you are expensing
capitalize
it.
when you're bringing something that wasn't there from the beginning.
Okay.
Assuming you finish building a house and then you are repainting the building. You are painting the
So
building afresh when it wasn't originally painted.
in
That's
summary,
an
sir,
addition.
in summary, are you capitalizing it or expending it?
I think overhauling should be expensed.
Okay, do
It
you have
can
any?
be expressed. It can be capitalized.
Yes, sir. I think. Hello, sir.
Why are we having
The
echo? Why?
overhauling now. Hello.
Go ahead, sir.
Okay, the overhauling depends. I don't know if the overhauling has to do with something that will prolong the lifespan of that particular asset or probably
Mm,
enhance its efficiency. I think that one can be capitalized. But if it has to do with maybe repairing a damaged part or
mm,
maybe a maintenance that is just for a short period, not something that will necessarily enhance the
mm.
capacity or probably in the lifespan, then in that case, it will be expensed. So that's
Okay, now
just my.
let me summarize what every one of you have said. When you hear the word overhauling, overhauling is capitalized. Why? The word overhauling means that you want to increase the capacity. Overhauling is not repair, it is not maintenance. Overhauling is not repair, it is not maintenance. It is in form of repair and maintenance, oh, but it will increase the capacity. For instance, if I have a generator that can only take a room self-contained, like I pass my neighbor, if I overhaul that generator and it can carry a two-bedroom flat, that one is not repair anymore. It is not repair and maintenance anymore. It is overhauling. Once it increases the capacity, then it becomes overhauling. The same thing applies to building. For a building now, let's say a certain building, an open space, and I decide to partition it and make rooms out of it. If I can increase the number of rooms in that building, that is building improvement. Do you understand? If I can increase the number of rooms, let's say it's a class, we want to use it for a class. So let's say before we are using it for uh, foundation, skills, and professional. If we can bring out all the structures from it and then we repartition it in such a way that it will contain ATS 1, 2, and 3, then foundation, skills, and professional. That remember, it's still the same building structure, but internally, inside, I have been able to partition it and increase the number of classes there. That is building improvement. It is a capital expenditure. So everywhere, no exemption, no exemption, no exception. Everywhere, anywhere you hear overhauling, building improvement, eh? It is what? A capital expense. Some people will tell you they are upgrading their cars. Have you heard of that word before? Upgrading a car. When they upgrade a car, it means your Toyota Corolla muzzle will work like, no, your Toyota Corolla 2008 will work like a muzzle, will perform like a muzzle, the same way a muzzle would perform. Do we understand? So that is what we have. All right. So we have 15 minutes to end this class or less. All right. Any question again? And shall we proceed? Shall we proceed, please?
Yes, sir.
Hello. Shall we proceed? Okay. Yes. Someone is saying yes. Okay. So now let's go back to our question.
Please, I have a question, sir.
Go ahead, please.
In the act of doing overhauling, let's say for an equipment, say for
Mm,
example, the cost of labor,
mm.
are we capitalizing it or we are to expense it?
Cost of labor for overhauling is capitalized. It's just like saying that cost of building, the labor cost of building an apartment, is it capitalized or expensed? Do you get my comparison now?
Yes, sir.
So if overhauling is capital in nature and building is also capital in nature, the cost of building, the labor cost of building, labor cost of building is also the same as the labor cost of overhauling. So it should be treated the same way.
Okay, okay. Because there was
Yes.
an agreement on that. So that was the reason I threw the question. Okay, thank you, sir.
No.
Yes.
Any other question? Don't forget overhauling itself, majorly, apart from the fact that you are buying an asset, you are incurring the cost now. And again, don't forget the cost is directly attributable to it. It's a direct cost, it's a variable cost, right? So all variable costs, all direct costs are part of the cost of the asset itself. Any other question before we proceed? Huh? Okay. So now let's go to B. So how do we treat this B now? All right. The cost of the overhauling is 25 million, 15 million for parts and equipment, and 10 million for labor. All right. Now the what's it called? How do we treat it? Yes, the cost of overhauling is 25 million. The directors proposed accrue the cost of overhaul over 2 years and create a provision for the liability. Yes. Is there any provision for liability on this asset? Hmm? Is there any obligation for this overhauling? Is it that we're mandated? Is there any contract that says that we have to overhaul this asset every 2 years? If there is no constructive obligation to undertake this overhauling, then we don't need to recognize it. All right. So now, for IFRS, all right. Now, the cost of the overhauling itself in total is 25 million. Cost of labor is part of the cost of the asset. I don't know if there is any other standard that says that we shouldn't treat it as, we shouldn't capitalize to it of labor to it. All right. I don't know if there is any standard, but in actual sense, the cost of that labor to overhauling is 10 million, and it is part of the cost of the asset. Do you understand? Now, this is it. If you don't spend that cost on labor every time, if it is not a repair, if it is overhauling that takes up that cost, then everything has to be capitalized. All right. And how do you treat it? How do you treat an asset? Yes, you record it in your statement of financial position, right? At cost, add it to the cost of the asset itself. All right. And then you depreciate. Am I right? Am I right?
No, you are right. Yes, you are right.
Yeah,
So
yes, sir.
Okay. So that is it. Now, we are overhauling this asset every 2 years. All right. We are overhauling the asset every 2 years. So if we are overhauling it every 2 years, then it means when you do it, when you recognize it in your financial statement, you have a carrying amount. Cost minus depreciation will be your carrying amount. Abi? So from that carrying amount is what you take to the next overhauling period. Do you understand? So the cost of overhauling the asset now should be recognized as a separate component in the financial statement. Hmm? And that is it. Any question? Go ahead, please.
Yeah, my question is, since they said this overhauling is every 2 years,
Mm,
now if we want to capture the value of this
mm,
25M, is it that for the present year now we are going to divide that figure by 2 and then maybe record 12.5 million, or how is it going to be done? Or
okay.
is it the whole 25 million that will be captured?
So the question did not specify if 25 million is per overhauling. And I think that's itself. The cost of the overhauling is 25 million. The cost of the overhaul are approximately 25 million. So we are
mm,
not informed, we are not told whether it is for the 2 years or it is for each overhauling. Do you understand? So if that is the case, whatever you want to narrate to, because you have to discuss, right? You're not
yes,
solving
sir.
any question. Whatever you want to narrate to them, don't shoot yourself in the foot. Yourself in the foot. Don't tell them, the company will recognize 25 million naira per month. I mean, per overhauling or for the 2 years. No, don't say that. Just say that the cost of the overhauling is 25 million and it is depreciated over its useful life. All right. So it is depreciated till the next overhauling period. So when the next overhauling period comes, you overhaul as well.
Mm.
Don't be silent on the cost because you are not sure. Even the question two is silent. All right. So that is that. Any other question? Any other question? Yes, I'm listening now.
Uh, my question is this. I'm trying to go through the suggested solution in the Pathfinder here.
Okay.
And then what they call it is a joint arrangement. And at a
Okay.
point, they said, I think at the point they mentioned joint operation. So I'm like, what's the difference between the two?
You just joined, right?
No?
Okay.
We are calling it, is it joint venture? We are asking, is it joint venture?
No, I we mentioned it earlier that it's a joint arrangement, right? And we said it is a joint. operation. Someone asked earlier as well if it is a joint operation or joint venture, and I said it is a joint operation.
Okay.
It's an investment in associates and it is a joint operation, not joint venture. All right.
Okay.
Any other question?
Hello, sir.
Yes, sir.
Yeah, I just want to confirm, please. These joint venture and joint operations, are they forms of joint arrangements?
Yes.
Okay, okay.
Joint arrangement is divided into two. It can be a joint venture, it can be a joint arrangement.
So the social
Any other
media
question?
law program that I was referring to earlier is the People's Parliament.
Sorry?
The law program on social media I was referring to earlier is the People's
Okay, yeah,
Parliament.
People's Parliament. I've heard of it before, but I have never gone through it. I've heard of it before. Is it on what social media is that?
It's on Facebook.
Okay. Well, I'm not really a Facebook fan, but of course I can look for it. People's Parliament. I'll do that. I'll look for it. Yes, any other question? So in the absence of question, we end our chat here tonight. See you all in our next class. Good night, everyone.
Good night and thank
Well, for last week, what we did was a fellow subsidiary. We touched the 5 steps, which is the group structure for I think Suka and Zara. Then we also did their net assets of each of the subsidiary at their acquisition dates, the reporting dates, and the post-acquisition position. Then also we did the calculation of a goodwill, which comprises of their purchase consideration, the NCI, which is a minority, then the next asset at acquisition, then their goodwill at acquisition, in which Zara has a negative goodwill. Then also we did the calculation of NCI, the net controlling non-controlling interest acquisition for each of for Zuka and Zara. Then also their acquisition position. They are consolidated the consolidated retained earnings for the parent company.
Okay, is that all?
Yeah, that is where I stopped. I don't know whether we have more, but that is where my network got me
Okay.
to. Yes, sir.
Yes. Who else? How many of us were in this class last week? How many of us was there last week in the class? I'm actually thinking of taking us through what we did last week. That's why I'm asking. All right, because I'm thinking of going through the material again. I mean the solution, because many are asking for the video of the solution. The video was not starting from the beginning. All right, so I sent the video, but it was part of it that delivered. So I thought everything had delivered actually before I deleted it, not knowing that only part of it was delivered. So I'm thinking of taking us through that video again for those of us who were not here last week, or anyone who has a question on how we got some of the things last week. And if you don't have anyone with any question, I guess we can start. We can continue. So how many of us were in class last week? Can we just signify?
I was in class last week.
Okay. Who else was in class last week? Do we need any? Has anyone gone through what we did last week? Has anyone gone through the material? Huh? Has anyone gone
Yes,
through the material?
yes,
Okay,
yes,
so what
yes,
do we
I
have?
have.
Do you have any issue from the material? From what you went through in the material, do you have any question from it, or we are good to go?
I don't have any question. The question I had, you already answered it. That was last week for the impairment, which you already answered. So, but I don't know. It seems that I'm the only one talking, but we have people in the platform. Let
Yes.
them talk.
Well, we have people here, but really, I think I've always said it in many of my classes that we all need to start conversing in this class, right? I told us that this class is not for me alone, it's for every one of us. And I said it last week that we don't have any wrong answer. So Mr. Benjamin was not in class last week. Okay, that is noted. But who else was in class last week? Do you have anyone in class last week? Okay, some of you are still on your way and you can't stop. Okay, so today we are looking at investment in associates. Okay, and this investment in associate, uh, we need to understand who an associate is. All right, and I believe you've done some of these things before, right? So we have joint venture, we have associates. Okay, so what is joint venture? What is associate? What is a joint operation, a joint arrangement, and the rest of them. All right, so these are the things we want to look at here, right? So now we know that when we have when you acquire more than 50% of the shares in a company, what do we call that? That makes you the parent company, right? All right, and that makes
Yes,
the acquired company the subsidiary. Am I right? So now the parent and the subsidiary. But what if you have less than 50%? What do we call that? Between 21 to 50%.
associates,
Sorry.
associates.
So between 21 to 49%, we call it a business associate, right? And from 1 to 20%, what do we call that? What do we call that? From 21, I mean from 0 or from 1% to 20%, what do we call it?
Investment in financial instruments.
Investment in financial instruments, right?
That's
Now,
ordinary investment.
no, yes, you can call it ordinary investment, you can call it investment in financial instruments as well. It's still, well, 20% is not ordinary, but of course, that's what we call it actually, right? We call it that, but looking at things, 20% shares in Dangote refinery. My sister is not just. It's not ordinary. In fact, it is extraordinary. I hope you understand. So sometimes you don't just, it's ordinary because it's ordinary ordinary investment, right? But in actual sense, it is not ordinary at times and even many times. Okay, so that's it. Now, this investment, now to look at joint venture. For joint, I think which one are we doing today, Seth? Investment in associates, right? So before that investment in associates, we have chapter 22, where we have joint arrangement, right? In our chapter 22, we have it as joint arrangement or associates and joint ventures. Okay. Oh, this, can I share my screen? Please let me share my screen. I need to uh, I need to share my screen, please. Let me bring it down here. Can we see the screen, please?
Not yet, sir.
Whoa. Okay. Okay. I think only the video is seeing my screen, not the. Okay. That's understood. 1 second, please. Can we see the screen now, please? Is that
Yes.
is still loading? Okay. Okay. Yeah. Now, for the joint venture, okay, let me take this away from here while I speak about it. So now, let's look at joint venture itself, right? And joint venture has to do with, I'll be very quick on this. We don't have much on joint venture. And joint venture is something we've always done in the past, right from our financial accounting, right? So joint venture has to do with an arrangement between two or more parties to have a joint control, right? Joint ownership, joint control. When we have a joint control like that, it means the profit and losses are to be shared equally as well, right? So that's it. Now the profit and losses are to be shared equally, right? Or based on the joint arrangement. And also, this joint control is a contractual agreement of sharing the control of the business, requiring unanimous consent. All of us must consent to it, okay, in order to make decisions about relevant activities. So all of us have the power to make decisions about the activities of the operations of the business, all right? So we have the types of joint arrangements as well. And here we have, under the type, we have the joint operation, we have the joint venture as well. So for the joint operation now, we have the rights and obligation under each of them, and we have the accounting standard that uh, that guides us in the preparation and presentation. Okay, so now for joint operation now, it is a right to assets and obligations for liabilities. All right, rights to assets and equal obligation, equal right to assets and equal obligation for the liability, which is IFRS 11, and it is structured with or without a separate vehicle. Then also we have the joint venture itself, which is right to net assets only. Joint operation is different from joint venture. Oh, someone said they can't hear me clearly. Can someone else confirm they can't hear me clearly? Can someone else confirm that? Okay. Miss Marvis, can you hear me?
Hello, sir. We can't hear you clearly, but you need to speak louder.
Okay, don't worry, I know what to do.
Just increase the volume of your system there.
Is it better now? Is it better now? Okay. So for the joint venture now, right? Joint venture has to do with the rights to the net asset only. Okay, and this we have it in our equity method, and that also must be structured. Now for joint operation, so the parties to joint operations are the joint operators, right? So they have to recognize their shares of assets, liabilities, revenues, and expenses. Don't forget, they have rights to both assets and also obligations to liabilities. Rights to assets, obligations to liabilities. And all these are what will directly be in their financial statement. So that's that. Now, example of joint operation can be two of us forming organization, right? Whereby we form a joint operation, having equally purchasing the assets, incurring the pipeline cost together, funding the expenses and liabilities together. In actual sense, all of this are to be done in 50-50. I think I left this example for another class again. I don't think it's something we need for this class. So, but regardless of what it is, I can just take us through before deleting it. So we have the maintenance cost of 1.2. We have the third party income of 900,000 that is received by Y. That is one of the partners and one of the venturers. Then also we have the loan interest paid by X 1.5 million. So in the financial statement of X, you have to divide everything by 50%, and financial statement of Y we also do the same thing. That is a joint operation. Whatever costs, expense, asset, liabilities you have, you share it equally or as per the joint venture ratio. All right, so that's it. Then also, but basically joint venture is usually in equal half. That is if it is two, right? Even if it is three, we share it equally. So that's it. Now for joint venture, it is an agreement where parties have right to net assets only, like we said, right? And here we are using the equity method under the IS 28. All right, so we adjust for our investor share of profit or loss. We do the dividend received, the OCI, other comprehensive income of the investee, right? So that's it. Now, and that investee, we are looking at the what do we call them, NCI. So for investment in associate and joint venture, an associate is an entity over which the investor has significant influence. Yes, all right. So an associate, significant influence. So that amount you have there, between 20 to 50%, is a huge and a significant interest, is a significant ownership interest. Then for joint venture, we have equal rights to the net asset only. So for equity method, all right, in this equity method, we record the investment at cost, right? Yes, Mr. Johnson, go ahead, please. Okay, yes, it is, sir. All right. So we record for investment at cost, we increase or decrease our share of post-acquisition profit, share of comprehensive income, and this is also reduced by the dividend that will be received by the investor, right? And a significant influence indicator. What can make you understand that this person has a significant influence on you, on your business? What can denote that? Number one, he has a representation on the board. The person is also part of the board, is a representative of the board or is part of the board of directors. Okay, the person participates in the policy making. He's not just a shareholder now. He participates in the policy making. Whenever you want to do a meeting, you must call him. All right. Then he has material transactions, or there is a material transaction. There are material transactions between the investor and that investor. That person is a material transaction between him and the business. All right. When we say a material transaction, a significant transaction that can affect the business. Okay. Then also there's an interchange of managerial personnel. So when you have all of this, then it's an indicator that that person has a significant influence, or that company has a significant influence. And I think we've talked about institutional investors, right? Can someone confirm that? Have we talked about institutional investors before? Institutional investors, please. Who are institutional investors? So let me make it a question. Who are institutional investors? Anybody, please? Yes? Institutional investor. Yes, they are pension companies, so we've mentioned them before as well in this class. So institutional investors are those investors that the only thing they do is to invest. All right. So whatever money they have, they gather the money and they invest that money. So a very good example is pension companies and insurance companies. All right. Yes. So they can also have a significant influence on the activities or operations of the business as well. Now, also looking at the structure and the comparison between a joint operation and a joint venture, right? So in terms of the structure, we can have a separate vehicle. What do you mean by this separate vehicle? We're mentioning separate vehicle, separate vehicle. What do we mean by a separate vehicle? Yes, anyone? What's a separate vehicle? Yes, what do we mean by separate vehicle? A separate entity. Thank you very much, sir. So they can operate like a separate organization, all right, or a separate entity. That is, you are preparing your own financial statements separately, just like the example X and Y we did earlier. All right, but under joint venture, no, it must be through a separate vehicle. Under joint operation, you can separate, you can decide not to separate. Now, for the rights, now we have equal rights to assets and equal obligation as well. But for joint venture, we have the rights to net assets only. Then also, for the accounting standard, IFRS 11 and IS 28, and for recognition in financial statement, right? So for joint operation now, you recognize them using the share of asset and liability, just as we did earlier. Yes, please go ahead, Mr. Benjamin. That's exactly what we are doing. That's the comparison. Okay. So when we operate together, joint operation is that the asset of the business, eh, you will record it in your account. You will record 50, let's say we have 50-50%, 50% shares in the joint operation. It means the asset, you only recognize 50% in your own account, while I recognize 50%. The liability, yes, ma'am. Mr. Chairman, are you saying something? We can't hear you, Mr. Chairman. Okay, let's continue, please. Now, for joint, okay, I want to mute her now. I don't know how to mute that. Ms. Choma, please mute yourself. All right, mute yourself. If we can't mute you, we'll be forced to remove you. We'll be forced to remove you. Then you have to log back in. Please mute yourself. I don't think she's with us in this class. Okay, I think she has left now, right? Okay, so I've removed her. So once she comes back in, we'll tell her to mute herself in case she wants to do anything on the ground. All right, so for a joint operation, is that if the asset is, please hold on, guys. So Miss Joma, please mute yourself in case you want to say something underground. All right, it was because we could hear you earlier and we were trying to mute you. We couldn't do that here, so that was why. Okay, now, so for joint operation is that if the asset is 1 million naira, we are sharing it 50-50. So you are recording 500,000 in your account, I'm recording 500,000 in my account. If the asset is, if the liability is 750,000, we are sharing it into 50-50. I'm taking 375, you are taking 375. If the revenue is 200,000, we are taking 50-50 as well. The same thing as the expenditure, we are taking them separately, 50-50. So you record 50% in your account, I record 50% in my own account. But if it is joint venture is that you record your own 100% separately, I'll record my own 100% separately. Do you understand? And for joint venture, we are recording only the net asset. All right, which means for the joint venture business now, in our income statement, we do the income statement together as a single economic unit, right? After doing the income statement together, we do the net profit. It is that net profit that we'll now share. That's the net asset. Do you understand? So that's what we share, and that is that. Then also for the recognition, we recognize the share of asset and liability for our joint operation, and we recognize the investment using equity method for joint venture. And a common example is when we have a joint oil field, a joint oil field, all right? Then we can also have manufacturing facility as well. But for joint venture, we have a separate legal entity like JV company. All right, so it's a separate legal entity, JV company. Now, the key concept here for IS 28, which is joint venture, is that you have the power to participate in financial and operating policy decisions, but you do not control the business, or you do not jointly control the business. Under joint operation, you control the business. All right. So for joint venture as well, you do not control the business alone. In fact, two of you do not control the business. You can only participate in the decision making. None of you, not partners here, none of the joint venturers can control the business in this case. Okay? So for the presumption now, if it is greater than 20% but less than 50%, we call it significant influence. If it is less, we call it a no significant influence. So indicators, I think we've explained the indicators earlier as well. Now, accounting for associate and joint venture, we have the equity method, whereby we look at the cost of the investment, we have the share of profit and loss account of the post-acquisition profit, we had your OCI, you less your impairment. That's the value of the investment. Now, when you're looking for the value of the investment, okay, so if you want to get the value of your investment in associate, that is how to calculate it. All right, so the cost of the investment had the post-acquisition profit from that investment okay, from that joint venture investment. Then add your share of OCI, and then you less any impairment. So that is your cost of investment in your financial position. So for the financial statement now, investment of course is shown in the financial position. Then your share of profit and loss will be shown in the P&L account, right? And your OCI is also, the share of OCI of the associate is also shown, all right? You show that in your OCI, your share of OCI. What is OCI? Other comprehensive income, right? So that's that. Then also trading with associates or JV. So when you want to trade with associates or a joint venture company, okay, you need to look at the intercompany balances. And in this case, they are not eliminated because associates are not part of the group company. If there is any intercompany transaction, you don't eliminate them the same way you eliminate them in business combination or consolidated financial statement. All right. So for your unrealized profit as well, only the investor's share of the unrealized profit is eliminated. Only me, the investor, only my share is eliminated, whether it is associate or joint venture. All right. And when the parent sells to the associate, you debit your cost of sales, right? Debit your retained earnings and credit your investment in associate when the parent sells to associate. All right. So that's it. Then also when associate sells to parent, you debit your share of profit and credit your inventory. That is for unrealized profit. Eh? So that is that. Now, for joint arrangements, IFRS 11, we have joint venture, right? We've discussed all of this before. All this, I think I recorded them twice. Okay, I recorded them twice. Okay, so that's all of this we are having. Okay, so let's look at the next information that we've not done. Oh, I guess that's all. Do we have any question on investment in associates? Does anyone have any question? Yes, ma'am. Good evening, ma'am. And yes, the center will share the slide with you. Yeah. So let's look for investment in associates. Let's look for a Pathfinder question on investment in associates, right? And joint venture. Does anyone have any question on it? I have. Should we solve the most recent questions or we'll start with the latest one? No, is it which one is okay? Which one is latest? Which one is recent? Anyone? Do we start from 2015 or start from 2020? Okay, so we have a question, November 2020 question 3. November 2020 question 3. Can someone do that for us? Can someone get the Pathfinder? Who has the Pathfinder? Let everyone have it though. If you don't want us to fight, so you can send it to the group. So you can send it to the group if you have it. November 2020 question what? Question 3. I hope you can see my screen. Oh no, you can't see my screen. Miss Penisire, Please, you might have to know. Okay. May I have it though? So, November 2020, question 3. Let me look at the 3. Question 3A actually. Discuss how the investment in Adoa PLC should be accounted for. And also, advise the directors, assist the directors, advise the directors how the deferred tax assets as arising should be accounted for. Then assist them in the blah 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 blah. Okay, so do we have the question now? Yes, please go ahead, sir. Oh, okay. My Microsoft Word. Okay. 1 second, please. Okay. I'm not sure I can bring this to this. No, don't worry, don't worry. I can. Let me do the. Okay, so it's on the main screen now. I'm coming. Let me just share my screen. I will share the screen. Then I'll start sharing. Okay. Okay. Okay, we can see my screen now, right? Okay. Yeah. So please, please reading for us. Someone has. Okay, people are outside. Yes, who is reading for us? Come on. Please go ahead. I, okay. Oh, this is the same diet you solved yesterday. I mean last week. Go ahead, please. We solved the question 1. Go ahead, please. required. Okay. Oh, why is it not saying? Okay. I'm trying to share my screen and I don't know what's happened to it again. I didn't close the. I'm still sharing this screen. Okay. So I guess please, if there is anyone waiting, because I'm not using the material now. I'm not using the page, the Zoom page, except I have to come down there to see. All right. If not, I'm not using it. So if there is anyone on the waiting for admission, please kindly let me know so I can add them. All right. So that's it. Now for two prints, how do we go about this question? Anyone? What do you think? What do we need to do here? So how do you think the investment in Adoa PLC should be accounted for in the financial statement? Yes. What is the percentage of stake in Adoa PLC? 18%. That 18%, what does it make us? Okay. Okay. Now, if it is an investment, we have 18%, not up to 20%, which means it's not investment in associate, right? But but we have a significant influence there because the largest shareholder, the majority shareholder, has 58%. Then the next person is we, 18%, right? While the remainder of the shares are held by 10 other shareholders, none of them is having more than 5%. So which means we have a significant influence in this business, right? Are you there? Hello, is anybody there? So we have a significant investment. Don't let me call it significant influence because it's not up to 20%, right? We have a significant investment in this business, but we are not, it is not an associate, it is an investment. Okay, so this investment we have now, how do we calculate investment? How do we recognize the investment? Those are the things we just did now. Do you understand? Those are the things we mentioned. That if you want to recognize it in the financial statement, right? We mentioned how to do the equity method where we said the cost of the investment. Am I right? Is anybody there? Eh? Can you hear me? Can you hear me, guys? Okay. So the investment itself, for us to recognize the investment in our own financial statement, we'll say that what's the cost of the investment, right? Then what is the investor's profit or loss? We had the profit or we less our losses from it, right? Then the share of OCI, other comprehensive income, we had that to it or we less. And then if there is any investment, we deduct, right? But don't forget, if you have any dividend as well, we have to deduct. We mentioned investment, we mentioned dividend deduction earlier in the earlier pages we discussed. All right. So when we have that, that will be our investment, the cost of our investment. Do you understand? So that is our cost of investment. So that's how we have to treat it. We have to treat it like an investment. Now, do we have any reason that can make us treat it? Is it an associate or ordinary investment? That's another thing. What do you think? Well, the question already told, but the question told us the directors feel that it should not be accounted for as an associate, right? But can we treat it as an associate? Do you agree with the director? So what do you treat it as? Equity instrument? Yes, sir. Please go ahead. Mm, mm, yes, yes. Mm, mm, yeah. Thank you. No, you are right. You are right. Is in the material. We discussed that. We discussed those indicators. All right. And what we can look at the significant influence indicators. We discussed them. And we said number one is if you have a representation on the board. I think someone is trying to come in. Okay, okay. And that's why. So once it ends, please let's get back immediately. Thank you, sir. So that means we spent 1 hour already. Okay, so we have a significant influence. How? Because we have a representation on the board. The board of directors of ADOA is made up of 12 members, while we have 3 members and the majority shareholder have 7. Do you understand? So we have to treat this business as a significant influence as an associate because we have members on the board. Do you understand? So they said 2Print was able to negotiate his representation on the board due to our strategic importance in their operations and expansion plan. So these are the things that can give us a significant influence. When we have a material transaction with them, when we are key to their what do we call it? When we are key to their success. All right. So these are the things we have. So this investment automatically is an investment in associates. Are we there, please? This is an investment in associates. Yes, I know. So we are coming back immediately. All right. So we can log out. We have logged out, sir.